The most powerful force in global markets right now isn't stocks. It isn't crypto. It isn't commodities. It's the US dollar. When the dollar moves, everything else reacts, often violently. Right now, the dollar is doing more than moving. It's shaking global markets. The US dollar isn't just America's currency. It's the world's reserve currency. Global trade, debt, and commodities are all priced and settled in dollars. When the dollar strengthens or weakens, pressure spreads everywhere. Let's start with what's driving it. The Federal Reserve is the primary driver. Higher US rates attract global capital. Money flows into dollar-denominated assets, and demand for dollars rises. That alone can tighten financial conditions worldwide. But a strong dollar is not always good news. For the US, it can reduce inflation. But for the rest of the world, it can create stress. Emerging markets suffer. Dollar-denominated debt becomes more expensive. Capital flows reverse. This is how currency crises began. We've seen this pattern in 2008, 2015, and 2022. When the dollar spikes, something usually breaks. Pressure builds. Now let's talk about the DXY index. It tracks the dollar against major currencies like the euro, yen, and pound. When DXY rises sharply, global liquidity tightens and risk assets struggle. Traders often ignore this until markets react violently. The Japanese yen is a perfect example. As US rates rose, the yen weakened, forcing Japan to intervene. Intervention is a warning sign. Europe faces a similar challenge with expensive energy imports. Global coordination becomes harder when the dollar dominates. When the dollar moves, it creates breakouts, false signals, and sudden reversals. Retail traders often get trapped chasing momentum without understanding the macro forces behind it. Forex isn't just charts. It's policy, capital flows, and global debt. Ignoring these turns trading into gambling. Another factor is US debt and deficits. As America issues more debt, foreign demand matters. If buyers hesitate, yields rise and markets destabilize. Now consider commodities. A strong dollar pressures gold, oil, and metals. A weaker dollar boosts them. This is why Forex traders indirectly influence commodity markets. The most dangerous environment is uncertainty. Volatility explodes when traders don't know the direction. This is when leverage destroys accounts. Smart Forex traders adapt. They respect macro trends, reduce leverage during uncertainty, and focus on risk management over prediction. They trade fewer, higher quality setups. Retail often does the opposite. The key lesson: the dollar isn't just another currency pair. It's the backbone of global finance. When it moves aggressively, everything else must adjust. Right now, the dollar is signaling tension, not collapse, not calm. Tension. Respect its power. History shows markets don't ignore tension forever. Do you understand the forces driving the move? Forex rewards awareness, not speed. The traders who survive respect the dollar's power, because when it shakes, everyone feels it. Follow for insights.